Are you new?
Yes.
Okay. So I'm not creating the groups yet. Then are you going to stay with us, or you just are you staying?
Yeah.
Okay. Right. That's nice then. So the groups will be then announced next week. The groups, not next week, this week, but Thursday. Okay. Looks like we have newcomers, so I have to see him. I have to put him in another group. In a group, sorry. He's in the group. So I'm again recording this video. I tested last time. It did work well, but I'm not going to upload that one because it's halfway through. I mean, half of the things that we did. So this will be a full recorded video. I'll upload it, and looks like the Blackboard doesn't support the extension that this guy records the file. That's the video file extension. So what I'll do is I'll upload everything on my YouTube channel from where you can watch, and I don't know, maybe I'll put the link to the announcements, or you can always go onto YouTube and search for London PhD. I don't have the marker here, and there you will find my YouTube channel, and if you click on the playlists, and you should have the FWN 5205. It's not uploaded yet, but I upload this one. Starting with this lecture, I'll upload all the lectures that we record. So only the screen is captured and my voice and your voices if you discuss or ask questions. Yeah. Okay. One thing that I want to start with is the news, financial news that you might have read. What happened to the FTSE 100 yesterday index? This is FTSE 100 index, I guess. Did you observe? No, you didn't monitor it, or you didn't see, you didn't check stock market. So maybe today, huh? It went down, yeah, by 16 billion. So anyone investing in FTSE index, tracking funds, lost fair amount. Obviously 16 billion out of I don't know the capitalization in there, but it's not a small amount. So altogether 16 billion was wiped out yesterday. What was it then? Did you read? Why did it happen?
Was it because of something to do with the interest rate?
Not necessarily. Usually interest rate, it has to be a very drastic measure for the stock market to be affected by the interest rate announcements. Usually if the interest rates are higher, what happens is that the investors pull their funds from the equity markets and put them into interest paying assets such as bonds, because then bond rates go up as well, because usually government does this, changes the base rate, or especially in recessions, they just take the drastic measures to reduce the interest rates to stimulate borrowing and investment and so on and so forth. Okay, so no reading? No one read the news? Try. It's just Hillary Clinton did something bad. You see how bad it affects the financial markets. Please read it.
What did she do?
Huh?
She got pneumonia.
She has pneumonia, and that means Donald Trump is going to be a president, and stock markets don't like it apparently.
Really? Like she said?
Huh?
She collapsed and
Yeah, at this 9/11.
No, but pneumonia is not a big problem. Is it like
Yeah, but
serious?
she's old.
She's 68-year-old. She's
Trump is
ill,
like 75.
and Trump is 75.
72.
But I think his health is much better. Looks like, or maybe he's pretending. But he is very robust in arguments. Well, at least in his own terms. But Hillary Clinton looks like has a fragile health. So this is being assessed by most likely speculators. Yeah. And I uploaded something yesterday. Have you read it? About speculation and how it might affect stock market. No? Please do have a look at the Blackboards at least once a week. I will always upload something to read, and the thing that I upload is a short reading on the role of speculation in the economy, especially stock markets. There are stock investors that are usually households, and there are investors who are speculators, and they usually create all this volatility in the stock markets. Not the households usually; they don't usually trade that often, but speculators buy and sell, and they speculate in they basically make the financial markets more volatile than they used to be. Yeah, did you raise your hand?
Can you just tell us what's the relation between Hillary Clinton and FTSE?
Well, it's the I think it's most likely the relationship between Donald Trump being the president and the FTSE, not Hillary Clinton. Hillary is more kind of in favor of financial markets and globalization, and Trump is against the financial globalization and is against the top banks, and he thinks that they are the destructive forces in the economy. And that's what he was saying. Look at Hillary Clinton. She speaks at Goldman Sachs and receives $100,000 per hour or something like that. And she's supporting them. Next thing is because they're lobbying Hillary Clinton. If Hillary Clinton becomes president, financial markets benefit at the expense of industry in the economy in the U.S. And what Donald Trump is trying to do is bring back the real industry. Remember the real industry, what we talked about, manufacturing, to the U.S., and to minimize the effect of financial services. So rather than having greater GDP contribution from financial services industry, he wants to bring in manufacturing, like Chinese economy, mostly supported by manufacturing, isn't it? And to some extent agriculture and very little financial services. But he needs to also understand, I guess, the fact that as the economy grows, the products that the economy produces becomes more high value added, knowledge based, not material based. So iPhone is a good example. If you look at iPhone, where is it designed?
You say?
Check that. The vacuum. It says California, right?
Yeah, assembled in China. Right?
But assembly in China, so assembly part is in China. That's because China adds little value to the iPhone. In other words, it costs little. But design part costs apparently huge. So how much do you think an iPhone costs usually to make for Apple? Have you did any study on that? Apple stocks last time?
When it comes to, do you include labor or?
Everything that Apple pays to the Foxconn to make the iPhone, for example, per handset.
$20.
Looks like $200, and they're selling it for $750. So there's a margin of $550, right? This $200 is rounded up. I don't know, it might change every year, but the article I read, it's always on the news. That's why I tell you, read the news. You will understand why stock prices are volatile, or why investments are dependent on the news. And that's why we also have the thing called efficient markets hypothesis, whole sort of chapter dedicated to information and how it flows in the financial markets. So anyway, so coming back to this Apple, I want to sort of highlight the difference between developed economy and developing economies. Developing economies specialize in manufacturing usually. Yeah, you look at them. When America was developing economy, it has very, very good industry, car industry. It has steel industry. It had all other oil industry, for example. Anything that's being manufactured in China now was manufactured U.S. back in 70s and 60s. They were self-sufficient. But at the time, again, it was developing. Now there is a status. They have the advanced economy status with the high wages. They cannot maintain or sustain manufacturing there and then again sell it to their own people because it would be too expensive to buy iPhone that's made in the US. Anyway, so coming back to this thing. So China adds only $200 value to the iPhone. £550 is being added by California, designers in California, Silicon Valley, right? So advanced economies usually specialize in high value adding activities. They do not produce. They produce ideas, they produce knowledge, they produce technologies. Apart from obviously, I think the weapons, they usually stay in where they are. You will not see American government asking Chinese factories to produce weapons, right? Because of it's easy to steal the ideas. And you can see a replica of iPhones easily among Chinese, yeah? So that's why ideas are more expensive than the manufacturing process itself. And Donald Trump basically has this sort of idea to bring back manufacturing, and it is destructive in nature, but it's good for American economy as long as the wages grow proportionally. Because if iPhone is made in the US as Donald Trump wants it, it will cost probably $2,000 or maybe more than that, because the wages per hour wage is too high there. The rent alone, I mean, you have to, Apple will have to hire this space, factory space, to make the actual phone, isn't it? So it's going to cost a lot. And what happens is that iPhones, then the margin on iPhone, the profit margin that Apple puts on iPhones, will become thinner and thinner. Because if they want to increase the margin, the price will go up and no one buys it, right? iPhones. So that's why, if profit margins decline, what declines for the investors? What's that thing that investors do not get?
Shareholder funds.
If I have shares, dividends, I will get, because profits decline, per share dividend will decline. I mean, my single share will give me very little dividend. Then why do I need to buy this stock? I sell it. So yesterday, investors sold shares, assuming that Donald Trump will be the front runner. I hope it was clear to you. What's his name? Simon? Samir. Sorry, what? Simeon?
Yeah.
No, sorry, I'm sorry.
Oh.
His name.
You're looking at me.
Yeah, sorry, I was looking at it. What's your name?
John.
Yeah, was it clear now why there's a link between Hillary Clinton's collapse and the stock markets? I just explained. So it's the dividends. If I'm not getting enough dividend yield, enough return, then I will sell. And that's what they did yesterday. Obviously, yesterday's thing, if you want, it wasn't big funds flowing out of Britain or FTSE. It's just speculation. But theoretically, that's the link between stock market and political activities. So keep reading, please, and it increases your commercial awareness. I hope you are planning to do some summer internship next time. Start applying if you're staying here, because this part-time job usually doesn't require work permit if you are from outside the US. Sorry, UK. So if you're not EU, then you can still do a part-time internship. If you keep reading, it helps you to sort of have a good response to the questions that usually might come in the interviews. They don't ask you to calculate dividend yield or to calculate some total return for stocks. They will ask you what you know in terms of current events and how they might affect the stock prices. Okay, so asset classes we've been looking at. We haven't looked at common stocks, we haven't looked at derivatives, but we did something about money markets. So we have through them very quickly. We have some new guys apparently, and then continue onto the remaining part. So let's look at money market securities. These are the ones that we've been looking at: treasury bills, certificates of deposits, CPs, bankers' acceptances, and so on and so forth. LIBOR, and we'll look at them now in a minute. These are slightly different slides. I decided to summarize everything so that this is easier, and I think there will be something on these topics in the midterm and a little bit more in final. T-bills basically summarize everything here. Default risk is zero usually, given that it's American security. Usually, government securities have zero default risk. That's what we expect. Similarly, American issued or U.S. Treasury bills have the same default risk, that they're theoretically we expect them not to default. Basically, the government will honor their obligations. Very high liquidity. Maturities range from 4 weeks to 52 weeks, from 1 month to a year. And so, actually, taxation is not important for this course, but that's something just as an information. You don't have to do taxation because it's U.S. related, but this is about global course. We have different people from around the world. Certificates of deposits. These are typical deposits. You can buy and sell. usual bank deposits. You can expect them to be bank deposits, function like bank deposits, for example, and you can buy and sell them as you.
That's on Blackboard, yeah.
No, it will be on Blackboard.
Yeah.
This is an updated version.
Basically, when we need to study for midterms or whatever, we'll have all of those just explained.
Yeah, yeah, and this video will be there. That we're talking now, it will be there. Then the commercial papers. The interesting thing is the new innovation now. Recently, they started trading asset-backed commercial papers. Lehman Brothers did this. Usually, these commercial papers are unsecured, issued by very fundamentally strong companies, which have potential to generate high amount of cash flows. But banks also started issuing them to generate short-term cash. But the problem with this commercial papers and the Lehman Brothers case was that I highlighted last time is that they borrowed using commercial paper sales and invested in long-term assets. So they had a problem with matching the maturities. There was maturity mismatch. So to buy long-term securities, they actually issued short-term debt. And next time, after 3 months, the expiry date comes, they actually either rolled over into a further short-term period or had to issue more securities to pay back these short-term securities. So that eventually there was a time where the crisis occurred in 2008, and then they were unable to raise any more funds in the short-term market, and they had huge amount of obligations, and that's how they become bankrupt. And here is just a summary of graph, basically, of commercial papers outstanding on a weekly basis. And as you can see, up to 2008, it was growing, and they had a huge crisis there in 2008. And market for commercial papers basically stopped. It became much more illiquid. They're supposed to be liquid. Commercial papers are very liquid assets. You can sell and buy very quickly. I mean, you can kind of liquidate your positions. If you bought them, you can easily sell them. But it looks like it was very difficult, and it was in the books that it appeared very liquid. But in times of secure crisis, financial crisis, none of the secure papers, other than the government bonds actually, or treasury bills, were secure. All of them were mostly highly insecure or highly default vulnerable securities. Okay, now bankers' acceptances. I think. Does anyone want to explain what it is? Bankers' acceptance. Is with an example. I had Bulgaria and US trading last time. Boeing engines.
Companies.
Yeah.
Basically, just show that the company has enough money to pay for the goods or
Okay.
get an acceptance from the bank.
Bank is basically just used as an intermediate. The bank knows how much money a company has, but it has to prove to the other company that company A has enough money to pay.
Yeah, go on. You're saying it in a way.
I'm just getting tangled in my own words sort of thing.
Anyone? Okay, go on. Anyone else wants to top up? I think they're right, but it's just not complete yet. They're correct statements. Any volunteer?
The bank knows how much money a company has.
Okay.
And it basically would pay the other company. I can't explain it.
Okay. No one? You had an example. The example that we had, remember? Do you want to explain? Because you need to be able to write an essay.
Yeah, no, I can try to explain the situation more. Like
Yeah.
that. Like he was saying, like company A needs to prove to company B that it has the money to pay them for what they need. So basically, the bank can get the banker's acceptance to basically prove to them that they can confirm to pay. So it sort of becomes that they're confirming that the payment will be made.
Okay, yeah. So this is usually common between exporting and importing companies. And it's usually cross-border transactions that needs to be, where this is used basically, not needs to be. What happens is that you might be a foreign company, you want to export, you want to import. she doesn't know you, and it's the first time she's exporting the items, for example. And what happens is that she requests, or you will usually request it to issue a banker's acceptance at your bank. For example, you are at an international bank. You have an account. You don't have to have the money. You could, the bank might provide you the loan, for example, right? You might want to do this. You just tell them that I need 100 million pound banker's acceptance. I would like to purchase these engines or Boeing example. This is usually a huge transaction, not small. And Boeing engines are expensive. This is an example again. 20 million or something, very big amount. So just say, let's say 100 million or 1 million. I started with 1 million. And if the bank accepts your request and gives you banker's acceptance, then she becomes the holder of the banker's acceptance because she's entitled to the money. Yeah, she will receive the money. Once she sends or delivers items to you, the money will be paid to her. Now this thing, the banker's acceptance may mature beyond the time when she needs the money. Basically, for example, she might need the money tomorrow, but the banker's acceptance matures in the next week, so she will have to wait a week. You may have already received the engines because it has been posted last year, for example, or last week. And then the bank will not release the cash to her until the end of the maturity date. So she may, as the holder of the banker's acceptance, trade this in the money markets and say, there's a 1 million pound in the bank account with this banker's acceptance. If you just pay me 950,000 pound, I'm gonna give you. I'm just give you this. I'm happy with the discount, 50,000 discount. But I just need the money today. So this banker's acceptance becomes a security traded in the financial markets, money markets. Is this clear? This is on its own is not a security, but once it's traded by her in the money markets, it becomes the money market security. Then the holder will now be entitled to receive the cash, 1 million cash from the bank, not the original holder, because the original holder sold it at a discount to me, for example, and now I will gain this difference, 50,000 pound, as my profit, right? Is that clear, guys? So she just decided that she needs the money now, and otherwise she could wait until the maturity date and she could receive 1 million. But because she urgently needs the cash to pay lease, factories are leased usually, or payroll, or suppliers, because she's also manufacturing, so she needs to pay. So that's how the banker's acceptance trade. And I could also trade this banker's acceptance. Receiving this 1 million, before receiving this 1 million, I may not wait, and I could trade it for a little bit of higher price. Yeah, if anyone wants to buy with it, the bank for 970, I could buy it with the profit of 20,000 pound, and the next person will receive in the end. So the holders can change. Yeah, bank eventually provides this cash, release the cash to the final holder. Yeah, okay. Another thing, euro dollars. What were they? What did we say about them? Did we actually cover this last time?
Isn't it when you use like a foreign currency in another country that's not that
Their currency? Yes,
Basically?
something like that.
It has nothing to do with euro.
No, it's certainly nothing to do with euro. It existed
Yeah, it's
in
using,
70s
like,
and 80s.
For example, like using US dollars and
Yeah, it's always dollar denominated. So you might have, you might receive, as a manufacturer, you might receive dollar payments while you are a Japanese company, for example. You can deposit it in a outside U.S. bank, any bank, for example. It could be, usually it's in London, but any bank really. And this is basically dollar deposited, dollar denominated deposits, which can be sold again. If I do not want to wait until the maturity of this, deposit, it's usually term deposit, then I could sell it at a discount to someone else in the money markets and receive little less than the deposit's original amount, right? So that's euro dollars, money market security, Fed funds. I guess we haven't talked about this. Now, have you had a class in bank management or banking, anything like this? In corporate finance, anything about banking? Nothing. So to explain this, what it is, usually the Fed funds, it sounds like something to do with Federal Reserve, the Central Bank of America, but it is not. It has minimal role in the determination of interest rates here. Well, it indirectly has. I'll explain what it is. For example, banks in the U.S., if they accept a dollar deposit, commercial banks, depository institutions, a dollar deposit from a customer, they will have to have reserve of 10% in Federal Reserve. You know, banks deposit with each other the money. They could also deposit with the central bank. So a dollar of deposit is their liability to you. So you invested, you deposit $1, they'll have to pay back $1 to you when you request. But U.S. government requires them to hold 10% of it, for example, in the Fed. And sometimes what happens is that Fed changes the reserve requirement. It may be 11% now. So 11% of £1 has to be there. Of each deposit, £1 has to be there in the Fed as a security in case the bank runs out of options to pay back or becomes illiquid. Federal Reserve releases this Fed deposits to the bank, which can then use to pay the deposit requirements or demand requirements. Now, if it's 11%, not 10, now bank will have to increase the reserve deposit in the Fed by this 1% increase, 1 percentage point increase. Then this bank requires cash to do that because they do not receive deposits every day. So what they do is they go to other banks, and other banks for overnight they could lend to this bank, which then this money will be going into the Fed reserve requirement account. In this process, we have Fed funds rates, at which I will borrow as a bank from another bank. So these are overnight rates usually. Fed funds rates are determined by overnight deposits. These overnight deposits are in money market instruments. Is this clear? So it's a long story. The reason I had to go back is because of banking class you didn't have. So again, every single commercial bank in the US is required to hold 10%, for example, of total deposits they have attracted from customers. So this 10% is actually has to be a cash that needs to be put in the Federal Reserve deposit account. Now imagine that Fed requires 15% sort of reserve requirement from banks, which means from every dollar that this bank received from depositors, 15p has to be in the Fed, and used to be 10p. So there has to be 5p extra that this bank has to put now. So the bank has to bring 5p per dollar extra to this Fed account. Now they have to borrow this amount because that's, if you expect, if you look at the total amount of liabilities or deposits that the bank has, it's a huge amount. From each dollar, 5p would become a billions of pounds. Usually, the bank then goes to the other bank and borrows from the other bank overnight. Usually, these are overnight deposits. Is this clear? I would have. I think it would be better to draw it, but maybe I'll bring the digitizer next time to explain this in more detail. Does anyone have?
Yeah, question. If the Fed increases the there's a percentage, would that mean banks increase interest rates so they could catch up on the difference?
Sorry, say it again.
If the banks try to increase
Which interest rate?
on loans,
Um,
they could make up for the loss.
No, it's not a loss actually.
They still have the money, but it's not available to them to use.
Usually, they need the cash very quickly because increasing the loan rates and the loan rates are usually for a year, isn't it? The interest payments they receive will be after a year or something like that. But the Fed reserve requirement could change overnight, and you have to find replenishment basically to top up the available reserves. Yeah, in the process of borrowing between the banks, they actually negotiate interest rates, and this interest rate is also called Federal Reserve, Fed funds rate. And Fed funds rate is usually a base for other interest rates. So if you apply for mortgage, it could be Fed funds rate plus some rate, some 2%. So it's going to be floating rate, for example, or Fed funds rate plus other interest rates. Is this clear at all, guys? You need to understand how banks operate in the US to understand this, but I guess this is going to take a little while. Maybe you have to have a little bit of reading, and I will do next week. I will do just explain this with drawings and in more details. So Fed funds are just funds traded between banks, nothing to do with the Federal Reserve. This is just the cash traded between the banks, loans traded between the banks to replenish the reserve requirements, to meet the reserve requirements at the Fed. LIBOR. I guess everyone knows what LIBOR is. It's London Interbank Offer Rate. Any suggestions? Anyone wants to give sort of?
It's like there's 18 banks that take like the middle 10 and they average out like their prices, and that's the rate for the day or whatever. It's calculated like 11 p.m. or 11 a.m. in the morning.
Yeah, every day there will be a sort of quotation of offer rates. Offer rates are the rates at which these banks are willing to borrow, for example, and they usually take the middle 50%. They just, of course, some banks could give you extreme rates. These all very small rates, basically. These are kind of truncated. So middle 50% of the bank's average rate will take in, and London Interbank rate offer rate is calculated, and this rate is used in money markets to price other securities usually, and oftentimes mortgages could be not necessarily housing mortgages, other types of mortgages for commercial premises could be based on LIBOR, or other short-term trading could be based on LIBOR rates. And repos. Any suggestions, anyone? Any suggestions? Any ideas about what repo is or was last time? Repurchase agreements. We briefly discussed that last time, and basically, usually it involves treasury bill transactions. If I have treasury bills, but I do not want to sell them, but I need some cash, I will give it to you, and I will, for certain amount of cash, I will give it to you basically, or I will sell it to you literally, for a certain amount of cash, for one day, for example. Next day, I'll purchase it at a higher price. So LIBOR may be treasury bill rate, maybe the interest rate that I'll pay you for that transaction on top of the purchase amount, or some certain fixed amount of cash I'll pay you for this sort of transaction. Is this clear? So basically, I will sort of sell you the treasury bills, and then obviously I have other use for this cash, and next morning I'll buy it from you. So it's this repurchase agreement. The short term, very short term. Usually, if it's a slightly long term, it will probably be 1 month. That I could buy at the beginning of the month, repo agreement with you. I could deal. It's not a security basically. It's a transaction in the money markets because it's short term nature. It's included in money market as part of money market instruments. Right? It's just a transaction, simple transaction. Yeah. So basically, you need cash. You have the treasury bills, but you don't want to sell them. So you expect to gain more from them. So you just he has cash as well. So you just do the transaction. You sell security bills, T-bills, and she gives you the cash. Next morning, you return the cash and she will return the cash. But the difference between the purchase and the buy amounts will be obviously slightly higher, so that she gains some, right?
If I can pay back
If you cannot, then she has the treasury bills. Yeah, yeah. If treasury bill is implicitly the collateral for this transaction, so she will now retain the treasury bills if you do not pay back. Sorry, buy back. Effectively, you will lose the treasury bills. She can then hold them or sell them as she wish. Okay, so this is not a security again. This is just a transaction in money markets. Have you traded before? Anyone? Or heard about this? Margin? Trading on margin? Or margin call? Usually your broker provides you a loan. As you may have £1,000, you invest it with a broker. Broker is someone who helps you to trade in stock markets, right? And they may offer you loans, and these loans are basically borrowed themselves from the banks. And you may then, once you get this loan, you may be trading on margin. And at any time, broker may call in the money. You might have to return the money back by selling your shares. So this is again a short-term transaction, and that's why it's part of money market transactions. So is that clear? So for trading, to do margin trading, basically, you will have to have some sort of equity. In other words, some sort of cash. Then, based on your credit worthiness, broker will provide extra cash to you. Obviously, you pay interest on that. It's like a short-term loan. And you will put together your equity plus the borrowed money, and you purchase the equities. When I say your equity, your cash. And if there is a call in by your broker, then you will have to return the cash back with the interest accumulated up to that point. Yeah.
Is this also like called leverage?
Leveraging, yeah, you can leverage, yeah. You can leverage your position.
No, I mean, like, do you pay interest?
Yeah, you pay interest, yeah, to the broker. To the broker.
To the broker,
Yeah,
because you borrow the money from
yeah,
the broker.
yeah. And the broker, in fact, also is borrowing from a bank. It's just a bank doesn't lend you to speculate in the financial markets, for example.
You have companies like they don't borrow from banks. They just borrow you, give you
Lend you their own money.
not their own. They give you money and they bet on you losing. You know what I mean? So they will pray for you to lose. You know what I mean?
Yeah, I understand that. Yeah, these are.
They'll take the money.
Yeah, yeah. They will still. You have to pay. If your position is lower than the required, level, you'll have to replenish. If the stock prices go down on your portfolio, obviously you have to replenish, top up. That actually increases. Yeah, keep putting the money. Yeah, and this money usually comes from brokers. That they keep lending you. So and then you pay extra on top of what's already there. So that's how they benefit. Obviously, they benefit from losses. And in financial markets, one thing you have to realize that for the one party to win, the other party should lose. Someone needs to lose for the other party to win. It's not win-win usually. So that's how bad it is. But that's how speculators also gain a lot of money, a lot of sort of profits in the process of win-loss. Okay, now we'll talk a little bit about money market mutual funds, but let's look at this timeline here from 1970s to 2012. Sorry, this is 14. This is the spread between the commercial certificates of deposit interest rates and treasury bills. Usually, treasury bills will have low rates, and certificate of deposit will have high rates. If the difference between them is high or increasing, this is the symptom of sort of a recession or crisis. So, certificate of deposits interest rate increases because it may become risky to deposit with certain banks, right? So this is actually average certificate of deposit interest rate. So if the market-wide average certificate of deposit increases, then there's a fear that in the future the bank is unable to pay back this deposit. So as we go along this timeline, you will see OPEC first, OPEC 2, Penn Square Bank crisis. Then there's a market crash of 1986. LTCM is basically long-term capital markets. It's another bank, investment bank, and financial crisis. So the difference between T-bill and this certificate of deposit interest rate is increasing in the run-up to this each crisis. So if you're tracking the financial market performances, this is one way to look at how things are becoming riskier or what you could expect in the future. And after financial, one big spike there, and it's just a quick decline. That's because U.S. government assured that depositors, certificate of deposits, will be insured. Deposits in these instruments will be insured. In other words, if the bank is unable to pay back, then obviously government will step in and pay back. So there's a quick sort of decline in the spread again. So this is like, have you heard about risk premium? The difference between, what was it?
The risk-free rate minus the market rate.
Go
Minus
on.
the market rate.
Okay, go on. Something like that, yes. Risk premium.
It's risk-free rate minus the market rate.
So it's the market rate minus risk premium, yeah? Risk-free rate, yeah? So it's the premium for investing in risky assets. It's the same here. Because it's the difference between certificate of deposit rate and the treasury bill. And again, treasury bill is risk-free rate, right? Because in the CAPM formula, remember what you did? You took the risk-free rate as the treasury bill rate, and the market rate is the market return. The difference is risk-free rate. Risk premium, right?
So basically, T-bills is at zero, lying zero.
No, yeah, no. Treasury bill is actually, this is the difference between them,
Yeah.
not the treasury bill rate.
Yeah.
It's the difference, yeah. If it's zero, it means they are equal.
Yeah.
CD rate and the T-bill rate is equal. That cannot be possible because bank has to be government then.
No, but what I mean is the comparison is the percentage. It's the certificates. How is it called?
Certificates of deposit,
Yeah, the certificates of deposit. Oh.
go on. So let's say, yeah, go on.
Right. So the percentage is basically showing how much more expensive the CDs are getting than the T-bills.
Exactly, yeah. This line is showing you how much more CDs are expensive than the T-bills in terms of interest rates. So if you see that 4.5, right, 4.5%, is basically saying us CD rate is 4.5% higher than the T-bill rate, which implies the government, sorry, not government, the markets expecting some sort of crisis, and at that point it's already crisis. So anything above T-bill rate implies basically a risky asset, right? Anything that requires a rate of return higher than the T-bills rate of return is a risky asset. But if risky assets become quite risky, this rate spikes usually. This graph spikes. It just increases over time, or just gives us a big spike, like yesterday's case. I only read on the FTSE's thing, but most likely money markets also spiked. We just need to see that now, because money market is also full of traders. Yeah, that trade in stock market. They usually trade between this, where the opportunities they pull the funds out and put them in there, or the opposite way. Yeah, so most likely there will be a spike for a day. Obviously, this is for a year, I guess. This one is for a year. Annual rates, and maybe monthly even. Sorry, it must be monthly. It's money market, so it must be monthly, and daily spike will probably be cancelling out there. Anyway, is this clear? This basically is useful in judging where we are going in the next next few months. So as you can see, it stabilized after the first spike, and there were spikes in 2012, spikes in 2010, small spikes, but these are minor, so 0.5% difference there between the CD and the T-bill rates. Zero means if this blue line just touched zero, that means I think end of the times. There's no profit in investing. There is no benefit in investing CDs. You just invest in T-bills as well, because CD issue becomes default-free company, and it's like their default risk is the same as U.S. government's risk, which usually is not possible for private company to be. Yeah. So this cannot just go here, and it probably doesn't go down as well. If it does go down, then world again changes big time, because U.S. government has to default on its treasury bills for this to go down into negative, because that means, the treasury bill rate is too higher than the CD rate. It's like a private companies is more secure than U.S. government. Yeah, if it goes down, yeah, more kind of financially stable than U.S. government. But that's probably not going to happen any sooner, at least in my lifetime. If financial markets go like this, and we have this sort of idea of self-destructing derivatives markets, then it may happen at some point. Anyway, I don't want to predict and do something. And money market mutual funds. Now, we talked about something about this last time. What was it? Money market mutual funds. I mean, you may not remember, but this is the important point why I'm recording this, so that you watch and come back next time when we ask questions, we will discuss, because it's important that we discuss rather than I talk.
But are you going to put the link on?
It looks like I'll have to put the link, because I tried to upload, it just doesn't support. I put the link. I don't know where to put it. I make an announcement and it will be there, because on the folder I don't have anything to
Are you
do.
going to put it today? Or?
Today, yeah. I'll upload this today and watch it for Thursday, and we'll come back to this in between the discussions. And obviously this will be, everything that we've been talking about will be in the midterm and final as well. No worries. So, money market mutual funds, what are they? Money market funds, for example. We talked about this usefulness of these funds in the past. Last week is, first thing is that they will enable individual investors to invest in money market instruments like certificates of deposit, like commercial papers, T-bills, and remember, denominations. These money market funds usually have denominations well above £100,000 or $100,000. And usually individuals may want to invest $50,000. And these money market funds are not then accessible to these individuals, money market securities. So they won't be able to invest. What happens is that with money market mutual funds, it is possible now. Individual could buy money market mutual fund shares for £50,000 and indirectly own whatever the money market mutual fund owns in the money market. And they could be commercial papers. So money market could be initiated by you, money market mutual fund. If you work for an investment bank, or there's a company called Avantgarde or PIMCO. There are other mutual funds, the fund management companies where the analysts manage the funds. I could come to you and give my £50,000 and buy the fund shares from you. If it's £1, I'll get 50,000 shares, for example. And you will use £50,000 to buy more money market securities. So what happens is that you get 50,000 from me, 50,000 from someone else, and 50,000 everyone. It becomes £1 million. Now £1 million can be invested in money markets. 50,000 alone cannot be, right? So you are indirectly helping me to earn some sort of interest in return for my funds. But what happens is that you pay me dividend, by the way, not interest, because you will receive all the interest payments as a company from money market issues, debt issues, and you will then issue the dividend every quarter. Is that clear? How money market mutual funds work? It's just a fund initiated by some investment manager by attracting sort of cash. For example, he might be a money market mutual fund manager, and you guys give him all your money. Unless he runs away, you'll be you'll be investing in money markets. And this is how the Ponzi scheme worked as well. Remember the Ponzi scheme? Have you heard about Ponzi scheme? The Bernie Madoff, or Madoff they call it now, Madoff Ponzi schemes. What happened is that he basically attracted, he was a fund manager, and what was he doing is, another thing he actually misused his position. He was the head of the Securities and Exchange Commission. This is a top organization in the US financial markets. They regulate the financial markets, and this guy basically opened a fund and manages it through his sort of affiliates, and his son as well was there, I guess. And because he's a heavyweight in securities market, in other words, he's a very reputable guy, very decent guy. He was. Even Goldman Sachs invested in his fund. Morgan Stanley invested in his funds. And basically, this fund basically blew up eventually because they started making losses and they started hiding it. So next time, if you come to demand your deposits from the fund, I would borrow from the other one. I mean, I would ask the funds from, I would attract funds from other investors and pay you, saying this is your return. In fact, the money is not coming from investments. The return you are getting is actually coming from others. So I will sort of buy and sort of attract and give you the cash, saying this is your return, as if I am doing very well. So funds performance was kind of not doing well. It was bad. It was towards 2007 and 8. It was unable to attract more deposits because of financial crisis, and was unable to pay back to the investors. And what happened is that it collapsed, and it turns out that it was a Ponzi scheme, pyramid scheme, where he was just, deceptively receiving all this cash and paying back as returns all this cash that he attracted. So that's one danger, or that's one sort of disadvantage of investing in mutual funds. But today there is more regulation than before, so it's fine. I guess they are more secure as the money markets themselves, because all the money that you invest in mutual funds go to money markets, and given the performance, you will receive dividends. And notice that by mid-2015, 43% of US households held mutual fund. They have shares in mutual funds. They have investments in mutual funds. So it's short-term securities. A household, instead of putting their cash in bank, they actually want more high returns. So they put in mutual funds. And collapse in mutual fund business means collapse in value of the households, which implies then they are unable to pay back their mortgages and car loans and all this debt instruments. And well, this is a crisis again. So mutual fund, a lot of it's very important, I should say, rather than kind of going into details here. So they are more like substitute for deposits. Now, this is what happened in money market mutual funds in the run-up to 2008 crisis. It grew in value. There was so much amount in the mutual funds. Households invested, businesses invested, banks invested. There was a huge amount of investment. But it did drop very badly. And I think we will see it in the next couple of slides. Fund managers basically lost big time. There was this reserve primary fund. It actually broke the buck. What it means is that its share price, or its share value, declined below $1. In other words, if you bought shares for $1, you will now receive less than $1 back if you sell them. Yeah, it actually started underperforming because the investments that they made in commercial papers, certificate of deposits, and treasury bills were not yielding as much as they used to be yielding because of financial crisis. So, and then seeing that there's decline in the value of my shares in mutual funds, I would want to, sell my shares to others, or to sell it back to the company, to fund managers. And there's something called run-on money market funds now, like run-on banks. And I know that you know what run-on banks are. Who doesn't know run-on banks? Who does not know run-on banks? You don't know, yeah? Good. That's honest answer here. Anyone? Basically, run-on banks is when, good, you have £100,000. You invested in Northern Rock in 2007. And in 2008, you will realize that this bank invested in subprime mortgages and is actually making losses. And you say, look, I had £100,000 in that bank. If I don't get it now, it becomes bankrupt. And I won't be able to get it back until after 10 years, because bankruptcy could last 10 years. Lehman Brothers bankruptcy is still going on, the administration of the bank. So you say, I'm going to go now and get my withdraw all the £100,000. And when you go there, you see 10 people in front of you. So you are the 11th person. You're waiting. And you ask them, how much are you going to withdraw? 500,000. The next guy, 100,000. And then you get 50 more people on the back. So you'll have a long queue. This is run-on banks. Everyone comes to the bank to demand at the same time their cash.
Didn't this happen in, I don't know, when, in London, some bank?
Exactly, yeah. Northern Rock. This was the example I'm giving. Northern Rock had a very long queue, and BBC was showing it. And
But I think it was on false assumptions, wasn't it?
no, it wasn't false though. Because 2008,
Okay.
it wasn't false. It was looks like, you know, the BBC commentator, economics commentator, at the time. Do you watch BBC business section? I don't remember the name. He's now at Channel 4. He's a big guy, Oxford-educated journalist, but economist. What he says is very important than the banks say usually. He basically mentioned one day ahead that Northern Rock will collapse. Next day, all the elderly people went there to demand their deposits. Because elderly people, they saved lifetime. They have hundreds of thousands, even millions of pounds. So they want their money back. And they want them in cash or transferred to another bank, right? That's what you want when you go to run to the bank. So at the same time, everyone going there means hundreds of millions of pounds needs to be withdrawn. But the bank will not have that much money. Even in the Federal Reserve, they won't have it. While the Federal Reserve's purpose was this, that when there's a run-on bank, you will use these funds to pay back. But there was more than, more people withdrawing than what's available in the bank. And Northern Rock, what happened is that they tried to borrow in the financial markets, issuing certificate deposit and commercial paper, but no one was lending them. The other bank says, listen, you guys are, not going to pay back in 3 months, so we won't lend you. So banks stopped lending each other. The word credit crunch comes from there. There was little credit available for banks themselves, let alone the individuals. So banks are supposed to be more kind of credit-worthy than the individuals, but banks were not able to borrow themselves. So eventually, run-on bank brought down Northern Rock because everyone was there. And Northern Rock was purchased by someone, I think it's a Metro Bank, or Virgin was trying to buy, Richard Branson was trying to buy Northern Rock. But anyway, this is not part of it. But is this clear now what run-on banks is? So there will be a question. You just need to be able to answer in clear detail with reference to whatever you think. It could be reference to Great Depression in US. That's the case when run-on bank occurred, or could be run-on bank in 2008. Either way, as long as you are clear in explanation, that's fine. Yes.
Also, in this example, you said like the BBC guy was the one who speculated the day before that.
It's
they
just
weren't
mentioned,
gonna
yeah, that
So if he wouldn't have done that, would that not have happened potentially that
maybe
day?
not the next day, but later they would read it anyway on the newspaper that Northern Rock is collapsing.
So speculation would then most of the time make that happen.
It could, yeah, it could be rumors as well, yeah. Speculation could happen as well, could bring down the bank as well. This bank is basically very kind of small bank compared to Barclays. It is a depository institution in the sense that they attract, not 10,000, but hundreds of thousands of pounds from depositors, and they issue mortgages. So this is like a building society. In the UK, they call it building societies. These are mortgage issuing banks, but attract huge amount of deposits. Mostly the elderly and all these people who has a lot of money, but nothing to do with this money. They deposit them. Okay. So run-on money market funds occurred back then is similar. So people started asking their deposits back from the mutual funds. This time it's the mutual funds, not the banks. But the U.S. government was quick to say, "I'll insure all the cash that you invested, so stay away. Don't withdraw it." If that happened in the UK, Northern Rock would have been better off. I think it happened a week later, saying government said £85,000 will be secure. If you invested 100,000 in Northern Rock, you will only lose 15,000 if it collapses.
But then you'd still want to go there and get your money.
Of course, I don't want to lose 15,000, so I will have to get it as soon as possible. Yeah, that's exactly the same that happened in the US. Now, mutual funds are run by managers, and there is an anecdotal evidence, and it is an experiment that you might find it a bit funny, but I found it a bit serious as well, that trusting your money to the people who cannot win monkey investments is actually not a good idea. Right, look at this now. Some time ago, I don't know when, but some academicians decided to see who performs well, monkeys or investment managers. And you know, investment bank managers are usually educated to a degree level from top banks, top companies, universities, Harvard, Oxford, Cambridge, stuff like that, LSE. What happened is that they asked fund managers in one room, okay, pick stocks, you have £1 million or dollars at the time, and start money market mutual fund, invest in mutual funds. And after a week, we will see how much return you will generate. So in one room, so this couple of people sit down and then did this experiment. Now, then in the next room, there were 5 monkeys, I think 4 or 5 monkeys. And on the floor, there were different securities. They were supposed to pick securities. You know, when you send the monkeys, they certainly pick up the objects. And they randomly picked up objects. These first objects were names of securities which were then put together as a portfolio. And their performance then tracked over time. And eventually what they concluded is that the money market managers performed as good as the monkeys. Monkey picks, basically. Monkeys picked up these securities, right? So you could actually pick up the securities yourself and invest in the security and still beat the money market managers. Instead of putting your £10,000 in there, plus paying the fee for this and plus all this taxation and stuff, you could do this as well as them apparently, because monkeys could perform well, better than the money market managers or the mutual fund managers. But there's a problem here. You cannot, with your £10,000, invest in money markets. So mutual funds is just something that's inevitably go through, right? But this is an interesting evidence.
What's the lowest amount then that you have to require money?
No, you could tell them to stop the trading if you are dealing with brokers. But if it's money market mutual funds, they usually update you. You don't have a say in when to stop in mutual funds. It's not brokerage.
Okay.
It's actually you just trust them the money and you expect dividends payback. That's all you expect from them. The bond market now, this is now capital markets, and I guess you know what the difference between money markets and capital markets is? Anyone? I wish days get a bit colder soon. It's even this not working. Anyone? What's the difference between money markets and capital markets? Some of you might know it because you discussed it last time. Yes, go on.
Capital markets are long-term, right? It's more than 12 months.
Yes, yeah. So money markets we discussed earlier that were up to 12 months. Securities traded in money markets usually mature within 12 months of investment. Yeah, and capital market instruments. If you invest your cash in capital markets, you are expected, if you want to hold till the maturity, then beyond a year. The securities issued in capital markets mature beyond 12 months. Yeah, that's why it's a long-term investment market. And bond market is one of them. Yeah, where governments are the biggest issues as well. Again, U.S. government is a good example. They have treasury bonds and treasury notes. An important thing is that you please understand the difference between notes and bonds. Bonds are for between 10 and 30 years. They will have maturities between 10 and 30 years. Notes will have something below 10 years. So they could be up to 10 years. Yeah? U.S. government might issue treasury note for 9 years and 99 months. Sorry, 12 months. So it's exactly 10 years, or not above it. Above it, it becomes a bond, treasury bond. So again, denominations are $100 and could be up to 1,000, and usually it's $1,000. So one paper of bond is usually tells us the face value of $1,000, and you just invest $1,000. In fact, unlike treasury bills, where the face value, you don't buy the treasury bills not at the face value. You buy them at discount because they don't pay interest. They pay you the difference between the discount and the face value in the end. So you buy treasury bills at discount and sell at par, usually when treasury buys them back. But with the bonds and notes, you could buy them at par value or at a different value, depending on the demand and auction results. These treasuries, these are initially auctioned off, but usually traded in the market, and some of the bonds could be as high as could be 3 or 4% higher than the original value in the price. So let's look at this example here, where you could see bid and ask prices. Can you all see this, guys? You have maturity dates. February 15, 2015. Coupon for this bond is 4%. Bid price is 101.6250%. These are in percentages of par value. And ask price is 101.6328%. Change is negative something there. We'll discuss what it is now in a minute. So what is the bid price usually? It's used for in many securities, but you can always have the same definition for it. Yes, go on. I think you wanted to say something? You? Yeah. No? Okay, bid price. What is the bid price? Anyone? Oh, sorry. What the buyer wants. The price the buyer wants to pay. Yes. So if you want to sell, you sell at the bid price. And if you want to buy, you buy at the ask price, right? Yeah. For example, £1,000 face value bond, if you want to buy, is going to cost you $1,016.32.8. So this is, I'm looking at this, I'm looking at this ask price now. So a bond that matures on 15th of February 2015 is being sold at this price, $1,016.32, basically. Yeah. Usually securities are traded at premium. So, for example, treasury bonds may be traded at premium. That means the price is above the face value. If it's traded below the face value, then it's being traded at discount. Yeah. And then change here is the difference between the last price and then the current price. Last closing prices could be yesterday's price, and there's a decline in the asked price, because ask price is the one you buy. That's why we usually have the ask price as the price of bonds here. And ask yield, so it's a yield to maturity, is 4.6%. You see, if you hold this bond, basically, if you buy it now and you hold it until 15th of February, you will effectively receive 4.6%, not 4%. Yeah? It's the yield to maturity, effective rate of interest that you will eventually receive. And 4% is a coupon amount. This is basically saying on £1,000 par value, on $1,000 par value or face value bond, I will receive $40 every year. And this is paid semi-annually, every half year. Every 6 months, I will receive £20 basically. This yield to maturity includes that cash flow as well. And when we come to the bonds chapter or bonds topic, we will do yield to maturity calculations, and it will become then clear. Okay, for now we'll move on to the tips. These securities tips usually it's their principal value is linked to the inflation rate. In other words, government will increase the principal value at the rate of inflation to protect the investors, so that they will clear real return, real value increased in the investment. So if I buy this securities for $1,000, next month, the price of this security will be £1,000 and 2 pence. Sorry, £1,000 and £1,002, let's say. So there is 20. That'll be huge. Inflation rate basically will be in the principal amount. Inflation rates are usually very low, 2%, 3%. So it will be £1,000 and 20 pence in this case. So my investment will grow in line with the inflation rate. So it will not be the same amount as I invested in the beginning. It will grow. The principal amount will grow in line with the inflation rate. So my real purchasing power is preserved there. This, that's a good way of sort of helping the consumers or households that the U.S. government is doing now. With the others, Khaya, for example, the original par value will stay the same, £1,000 when it's mature. But with this security, TIPS, what happens is that the principal amount will grow as well, plus the interest payments. Yeah. And then other securities that governments issue in the capital markets are the agency issues. Federal government debt. Sometimes I don't know if they're very as credible as they used to be. These are federal home mortgage associations. They provide loans to banks, which then provide mortgages to the other companies, so to the consumers, to the public. So government tries to help these agencies basically by, guaranteeing their borrowings. Remember, they used to not guarantee, but in financial crisis, two agencies, Fannie Mae, I think. Do you remember this? Agencies, mortgage loan, federal loan agencies. I don't remember the acronym for them, but there were two major organizations which basically speculated in mortgage-backed securities market. And when the mortgage-backed securities market collapsed, their holdings collapsed, their value declined a lot, and U.S. government had to bail them out. Huge amounts has to be pumped into these agencies. And agencies issue these bonds as well, the securities, which they then use to make loans to the other banks, commercial banks, which then makes loans to the consumers. You see the line? There's so much connection between these things. Yeah, that's agency issues or agency security issues. Then comes the municipal bonds, where again local and state organizations can issue bonds. Maybe hospitals could do this. For example, hospital renovations will be, given the large size of them, it will be expensive, so they could issue securities to raise the funds. Or airports may want to extend the runways, and they will require millions of pounds and even more. So they issue these bonds as well, municipal bonds. There are two types of them: general obligation municipal bonds and revenue bonds. The general obligation municipal bonds are usually issued by these organizations that I just mentioned, port authorities or tollways managers or agencies that manage this to tollways. Or then the next one is the revenue bonds. The revenue municipal bonds are issued by the government or municipalities in local areas. What they do is they may want to build this factory in which a private company will be operating. So the interest payments will be based on the revenue that is generated from these factories. While general obligations, the expectation is that tax payments to the U.S. government will be backing the payments of these municipal bonds back. Yeah, so the collateral on general obligation municipal bonds basically is the tax receipts that we expect that all this spending on hospitals that we borrowed money for will be paid back using taxes, while revenue municipal bonds are collateralized, or the collateral for these revenue bonds will be the revenue from the use of these factories, for example, built by the government for the purpose of leasing to maybe private organizations. So Detroit, for example, is one example. What happened to Detroit car market or car industry?
Collapsed.
It doesn't exist now, does it? If you may have watched the documentary showing the homes and all these factories running down, basically, and people aren't there. But Detroit, if it wants to revitalize, under Donald Trump, example, municipal bond must be issued because Donald Trump is not going to pump his own money in the car market. So Detroit may issue this, some local authority within Detroit, maybe it's, what's the state Detroit is in? Massachusetts? No, Michigan. So Detroit state or local government, what you call this? I don't know what you call federal area, Detroit. It's state government, isn't it? So the state government may issue the loans to build the factories again, to lease, for example, to General Motors or Ford. And Ford obviously by selling cars generates all this cash, and in return this cash is a collateral for the revenue bonds, so industrial development bonds. Okay, we will continue next, will be Thursday, next lesson, and I would probably like to listen more from you rather than you being sleepy and tired.
Can you maybe put the slides before the class so we can maybe have
Do you
a
want?
look
Okay.
at it and
I'll
then
do
be able to comment?
Okay, I'll do that. Yeah, but I want you to, to discuss from your past experience and what you know. But I will upload them beforehand. Then, yeah, if you want them. Yeah. The thing is, these slides will contain the answers. When I ask, you may end up giving the answers that I have already put. But I want something from you as well. Okay, I'll put them on. The idea is, guys, you read the materials I described on the syllabus, like chapters, and come, and then we do discussions. But anyway, I'll upload them.
Thank you.